Welcome to Invest with Neko B.
Please like this video, comment, and subscribe to our channel.
The information provided on this podcast is for educational and informational purposes only and should not be considered financial, investment, or legal advice. I am not a financial advisor, and the strategies or assets discussed may not be suitable for your personal financial situation. Investing involves risk, including the loss of principal. You should always consult with a licensed professional before making any financial decisions.
You know, there is this ultimate investor fantasy out there.
Oh, absolutely.
It's the dream of earning these massive double-digit yields.
Right.
Like we're talking 8 to 15% paid out as cold, hard cash every single month.
Right. And, regardless of what the broader market is actually doing, which is just an incredibly alluring concept.
Oh, for sure.
I mean, we are literally wired to crave that kind of visible, predictable reward, especially when the financial headlines feel, well, totally chaotic.
It really is like having a magical ATM right in your living room. The market drops, cash dispenses.
Exactly. The market chops sideways, cash dispenses.
Yeah. But then you look under the hood of how these massive yields are actually generated by derivative income ETFs. And suddenly that magical ATM starts looking a lot more like a really complex, potentially leaky plumbing system.
It does, because it really boils down to the absolute definition of an income trade-off. You are basically exchanging one type of wealth for another. And if you don't understand the mechanics of that exchange, well, you can end up destroying your own capital.
Right, which is exactly why we are tackling this today.
Yeah.
We have this massive stack of sources in front of us, financial analyses, historical performance data, and some incredibly dense IRS tax breakdowns on these derivative income ETFs.
Very dense.
Yeah, no kidding. So our mission for this deep dive is to provide you, the listener, with a really practical, decisive sort of tournament bracket showdown.
I like that.
By the end of this, you will have a clear, quick decision guide for the 4 main covered call ETFs. That's QYLD, QQQI, JEPI, and XYLD. You'll know exactly which one to use and when.
Sounds like a solid plan.
Okay, let's unpack this. Is this actual free money, or are we just renting out our upside?
We are absolutely renting out the upside. I mean, that is the fundamental mechanism driving every single one of these funds.
Yeah.
To generate these massive double-digit yields, the fund managers sell what are called covered call options. So in plain English, they are selling someone else the right to buy the fund's underlying stocks if those stocks go up in price.
Got it.
And the fund gets paid a cash premium upfront for selling that right. Then they basically just pass that cash directly to you as a monthly yield.
Okay, let me make sure I'm wrapping my head around this. If the market goes on a massive run, we don't get to keep those gains because we already sold the rights away for that upfront cash.
Right, exactly.
It sounds like leasing out the penthouse of your portfolio. You get a great monthly rent check, but if property values absolutely skyrocket, the renter is the one making the real profit.
Yeah, that analogy hits the nail on the head. You own the building, but you've capped your profit on the best unit. You are artificially capping your capital appreciation in exchange for immediate income. And because that cap is structural, the specific underlying index you choose to run this strategy on changes your entire risk profile.
That makes total sense. Like the volatility of the neighborhood dictates the rent, so to speak.
Exactly.
So before we crown a winner, we really need to understand the safer side of the pool. Because covered calls cap your upside, starting with a defensive index seems like the logical first step, right?
Absolutely.
So let's look at the defensive players tracking the S&P 500, starting with JEPI. Let me give you the one-sentence summary here. JEPI actively manages covered calls on a defensive, low-volatility slice of the S&P 500 using equity-linked notes to preserve capital.
Yeah, and JEPI has really become the heavyweight champion of this conservative space.
Yeah, it's huge.
It is. It's run by JP Morgan, charges a very low fee of 0.35%, and throws off a yield of roughly 8 to 9%. And, to understand why it captured so much of the market's attention, you just have to look at its defining moment during the 2022 bear market.
Oh, man, 2022 was a brutal year for almost everyone. The S&P 500 dropped, about 18%?
Yeah, close to it. But JEPI only fell roughly 3.5% on a total return basis.
Yeah.
So while the broader market was just burning, JEPI barely got singed.
Wait, how did it pull that off just by selling options?
Well, it goes a bit deeper than that. First, there's the active management component. The managers deliberately pick lower volatility, defensive stocks to whole think,
Yeah.
like healthcare and consumer staples,
Okay.
while actively avoiding those high-flying, really volatile tech names.
Yeah.
And second, the cash premiums they collected from selling those covered calls acted like a shock absorber.
Well,
It physically cushioned the drop in the share price.
I mean, I see the appeal. During a crash, that rent check is an absolute lifesaver. But wait, I want to back up to something I mentioned in that one-sentence summary.
Sure.
Equity-linked notes, or ELNs. What exactly are those? Are they not just, logging into a brokerage and selling options like a normal trader?
So this is where the plumbing gets very interesting. They are not just selling standard options on an exchange. An equity-linked note is essentially a debt instrument. JPI is lending money to another financial institution, usually a major bank, and in return, that bank promises to pay JPI a return that mimics the payout of a covered call strategy.
Hold on. So JPI is taking on counterparty risk. Like if the bank issuing the note runs into trouble, that could be a huge problem.
It introduces a layer of counterparty risk, yes.
Yikes.
I mean, the fund limits this by spreading the notes across multiple major banks, but it is a distinct structural difference from just holding stocks and selling options directly.
Right.
They use ELNs because it allows the managers to generate options-like income without having to constantly trade thousands of individual contracts. It keeps costs and turnover really low.
Okay, that clarifies things. So now let's look at its rival in the S&P 500 bracket, which is XYLD.
Right.
Here is the one-sentence summary for this one. XYLD uses direct equity options to write covered calls on the full S&P 500, offering slightly higher yields than JPI, but with a different tax profile.
Yeah, so XYLD takes a much more mechanical approach compared to JPI.
Oh, so.
Well, instead of cherry-picking safe stocks, it just blindly holds the entire S&P 500 index. And instead of using those complex equity-linked notes we just discussed, it uses direct index options. It charges a higher fee, around 0.60%, and typically yields a bit more, somewhere in that 10 to 12% range.
Wait, let me stop you there because the math feels a bit lopsided to me.
What do you mean?
Well, if JPI performed so well in 2022, has lower volatility, and is nearly half the price in fees at 0.35%, why would anyone ever look at XYLD? Like, income is income, right?
On the surface, yeah, JPI looks like the obvious winner, but the IRS views the income from those two funds very differently.
Oh, of course they do.
Right. The income from an ELN is not treated the same as the income from a direct index option under the tax code. We are actually going to dive into the exact math of that tax bomb in a few minutes.
Oh, I can't wait.
But for now, just keep in mind that the structure of the fund dictates how much of that yield you actually get to keep.
Okay, consider my curiosity officially piqued. So if the S&P 500 funds are the conservative rent, what happens when investors get greedy?
They look for more volatility.
Exactly. If you want to maximize that premium, you have to move to a more volatile neighborhood. You move to the NASDAQ 100. More volatility equals higher option premiums, but obviously the risks have to multiply dramatically.
They really do.
So let's look at the first contender here, which is QYLD. To summarize it, QYLD writes naked call options on the NASDAQ 100 to maximize income, but leaves you fully exposed to downside crashes.
Yeah, this fund perfectly illustrates what financial analysts call the income trap.
The income trap. Sounds ominous.
It is. The NASDAQ 100 is packed with volatile tech giants.
Yeah.
And because the index swings so wildly, option buyers are willing to pay massive premiums for the right to capture its upside.
Makes sense.
So QYLD captures those premiums mechanically, routinely paying out headline yields of 11 to 13%.
A 13% yield sounds incredible, but
Yeah.
there has to be a catch. Like, you can't just harvest 13% risk-free.
You certainly can't. And the historical data from 2021 to 2023 absolutely proves it. Investors just piled into QYLD, collecting those massive monthly checks. But remember, QYLD writes calls mechanically right at the current market price, what we call at the money.
Okay, let's walk through what that actually means for the listener's money.
Sure. Let's say the index is at $100. QYLD writes a call option at $100, effectively saying no matter how high the market goes this month, we agree to sell at $100.
Right.
Now imagine the market crashes 10%. The index is now at $90. QYLD captures that full 10% drop because it has zero downside protection.
Ouch. But, I mean, markets recover eventually, right?
They do, but here's the fatal flaw in the mechanics. The next month, the index is at $90. So QYLD mechanically writes a new call option at $90.
Oh, no.
Yeah, if the market suddenly surges back up to 100, QYLD doesn't get to participate. Its upside is completely capped at $90. It is forced to lock in that loss.
Wait, here's where it gets really interesting. I'm getting a 12% yield, but my actual account value is permanently ratcheting downward.
Yeah.
Like every time the market dips, I take the full hit, but every time it recovers, I hit my head on a new lower ceiling. That's like trying to bail water out of a sinking boat with a massive hole in the bottom.
That ratchet effect is known as the whipsaw.
Mm.
And over that 2021 to 2023 period, the share price of QYLD dropped from $25 all the way down to $16.
It's horrible.
It is a 36% loss of your initial principal. So even after you factor in all those juicy 12% monthly dividend checks, the total return for the investor was actually negative.
Wow.
People were blinded by the headline yield, completely ignoring the fact that their underlying wealth was bleeding out. They suffered a permanent erosion of their net asset value.
That is just terrifying for someone trying to build a stable retirement. You think you're generating income, but you're just slowly consuming your own savings. Is there any way to plug that hole in the boat?
There is. The financial industry realized this structural flaw and basically had to evolve. Enter the challenger, which is QQQI.
Okay, let me give the listener the one-sentence breakdown of this one. QQQI runs on the NASDAQ 100, but uses a protective put collar, capping both your upside and your maximum loss.
Right, and it is a critical evolution. The managers of QQQI looked at the absolute carnage of pure covered call funds during whipsaw markets and realized a safety net was just mandatory.
Makes total sense.
So QQQI takes a portion of the cash income it generates from selling calls, and it uses that cash to buy put options. And a put option is essentially a financial insurance policy that pays out if the market crashes.
Okay, so to make sure we have this totally clear, let's deliver the exact required distinction here. QYLD writes naked calls for maximum yield with unlimited downside, while QQQI uses a protective put collar to give you a hard floor on your losses. It's like putting bumpers on the bowling alley.
Exactly. It creates a defined risk profile. You know mathematically what your maximum loss can be in any given month.
Right.
Now, buying that insurance costs money, which means QQQI's yield will naturally be slightly lower than QYLD's absolute maximum yield, though, I mean, it still aims for those double digits dynamically.
Okay, let me push back on the entire premise of combining tech and covered calls, though.
Sure, go ahead.
If I'm investing in the NASDAQ 100, I'm doing it because I want aggressive tech growth. I want NVIDIA and Apple to just run wild. Is QQQI's floor actually worth the cost if I'm accepting a much lower total return during a screaming tech bull market? Because plain old unhedged tech funds have absolutely crushed these covered call strategies over the last few years.
That's a totally fair point. If we connect this to the bigger picture of portfolio construction, you really have to ask what job you're hiring the fund to do.
Okay.
If you are 30 years old and you want maximum unadulterated compounding tech growth over a 2-decade horizon, you just shouldn't be in covered call ETFs at all. You should just buy a standard NASDAQ index fund.
So who are these even for then?
Retirees, mostly. Or someone who needs to extract 10% in cash from their portfolio every single year to pay for their living expenses.
I see.
Yeah, if you need cash flow. But you still want some exposure to tech innovation without the risk of waking up to a 30% drawdown that completely wipes out your principal. Well, that floor is incredibly valuable. QQQI is simply a more honest fund for risk-conscious income investors.
Okay, so we've established the mechanics here. We have the conservative S&P Guardians, JEPI and XYLD, and we have the high-octane NASDAQ contenders, QYLD and QQQI.
Yep.
But knowing the tools is only half the battle. The other half, which honestly ruins most retail investors' returns, is where you hold the fund. This brings us back to the cliffhanger from earlier. Let's talk about the hidden tax bomb.
Yes. This is the silent killer of yield, and it's where most investors just get completely blindsided. People see a 12% yield on their screen, and they assume they get to spend 12%. They don't.
Because the IRS wants their cut, naturally. But why is this worse than just a normal dividend stock?
It all comes down to classification. If you own a normal dividend-paying stock, like, say, a utility company, that income is often classified by the IRS as a qualified dividend.
Right.
And you pay a lower, much more favorable tax rate on it, usually around 15%. But the income generated by covered call ETFs is mostly derived from option premiums, or in GPI's case, those equity-linked notes we dissected earlier.
And I'm guessing the IRS does not treat option premiums and debt notes as qualified dividends.
Not even close. The IRS treats them as ordinary income.
Oh, boy.
Yeah. That means every dollar of that yield is taxed at your highest marginal tax bracket.
Yeah.
If you were a high earner, that could be 32%, 35%, or even 37% going straight to the government.
Wow. So a 10% yield in a taxable account is just a bucket with a massive 30% hole in it.
Exactly.
A 12% headline yield can effectively shrink down to a 7.5% actual yield after taxes. That fundamentally changes the math of why you'd even buy the fund in the first place.
It absolutely does. Which is why the account you choose to hold these funds in is just as important as the fund itself. So let's resolve the XYLD versus JPI mystery from earlier. Remember how XYLD uses direct index options instead of ELNs?
Yes, and it charges a higher fee to do it.
Right. But under IRS rules, specifically a piece of the tax code called Section 1256, cash-settled broad index options get a special blended tax rate.
Okay, how does that work?
The IRS dictates that 60% of the gains from those options are taxed at the highly favorable long-term capital gains rate, and only 40% are taxed at the short-term ordinary income rate.
Hold on, let me make sure I heard that right. Even if the fund only holds the option contract for a few days or a month, the IRS just waves a magic wand and pretends 60% of it was held for over a year, giving you the cheaper tax rate.
That is exactly how Section 1256 works. It is a massive structural tax advantage for direct index options over the equity-linked notes that JPI uses.
That is wild. So if you are forced to hold an income ETF in a normal taxable brokerage account, XYLD's tax efficiency will often allow it to outperform JPI's net of tax yield for a high earner, even if XYLD has slightly higher fees or slightly lower gross performance.
You've got it. That is the exact level of detail that actually pays for a comfortable retirement.
So what does this all mean for you when you log into your brokerage account tomorrow? We promised a decisive guide, so let's lay out the ultimate account rules for our listeners right now.
Let's do it.
Rule number 1, Roth IRA.
The rule is Roth IRA equals QYLD for max compounding.
Okay.
A Roth IRA is a completely tax-free environment. It acts as a titanium shield against that ordinary income tax bomb. So you can harvest that massive aggressive NASDAQ yield from QYLD, reinvest it, and compound it entirely tax-free. You just have to be willing to stomach the volatility and the NAV erosion we discussed earlier.
Right, the leaky boat. Okay, rule number 2, traditional IRA.
Traditional IRA equals JEPI for clean income. Remember, JEPI is the conservative champion. It's built for capital preservation using those equity-linked notes. Inside a tax-deferred account like a traditional IRA, the ordinary income classification of those notes just doesn't matter because all withdrawals from a traditional IRA are taxed as ordinary income anyway.
Ah, clever.
Right, so you get this steady, reliable S&P exposure and zero immediate tax friction on the distributions. It's really perfect for retirees actively drawing down their accounts.
And finally, rule number 3, taxable accounts.
Taxable equals XYLD for tax efficiency. Because of that Section 1256 magic wand we talked about, XYLD gives you the 60-40 tax split. That shelters a significant portion of your yield from your highest marginal tax bracket.
Okay, well, it's time to close the tournament bracket and give everyone their definitive cheat sheet answer. We covered a lot of ground today, from the whipsaw effect to ELNs and the tax code, but we promised clarity, so here it is.
Lay it on them.
Lock this into your memory. QYLD equals max, yield max risk NASDAQ. QQQI equals NASDAQ with a floor. JEPI equals conservative S&P income. XYLD equals S&P with bar tax treatment.
That summary captures the entire landscape perfectly.
Awesome.
The overarching lesson across all 4 of these funds is that chasing a headline yield in a vacuum is a massive rookie mistake. A 12% yield means absolutely nothing if you lose 15% of your principal to NAV erosion and then give up another 35% of the remaining yield to taxes.
Preach.
Right. Total return, which is your yield plus the change in the share price and your tax placement, are the only things that actually build real wealth over time.
Total return is the only truth. But before we wrap up, I want to throw one last wrench into the gears here.
All right.
We've spent this entire deep dive analyzing how these funds generate their massive 8 to 15% yields. And the core engine behind all of them is basically harvesting market volatility.
That's right. Consider how the math plays out. The entire ecosystem of derivative income relies on fear and movement. Option premiums are only expensive because the market expects stocks to swing wildly. When volatility is high, yields are high.
So my question for you, the listener, to mull over is this. What happens to your monthly income factory if the market suddenly enters a decade of flat, historically low volatility? If the VIX drops and stays down, those option premiums just dry up. Will your magical ATM suddenly stop dispensing cash exactly when you need it to retire?
It is the glaring blind spot of the current income craze, for sure. Everyone assumes the premiums will always be as juicy as they have been over the last few chaotic years. But history tells us that isn't really a safe bet.
It brings us right back to the beginning. We all want the fantasy of the magical ATM in the living room spitting out cash no matter what. But the reality is you're just leasing out the penthouse.
Exactly.
And you better make sure you understand the lease agreement, the tax bill, and whether or not the renter is actually going to show up next month.
Know your tools and definitely know your accounts.
Absolutely. Thanks for diving deep with us today.
That's a wrap for today. See you tomorrow with another lesson.
Don't forget to like and subscribe. See you then!